All right, we're going to kick things off here today. Just want to get started by thanking everyone for logging in. I know there's some people still rolling in, so if anyone hops on a little bit after, this will be a recorded session, just like all of these are. We'll circulate the video for those that are in attendance or that RSVP'd after, as well as access to the slide deck. So we appreciate you dialing in. Topic of today's quarterly market insights is quarter one 2024. Um, a relatively some that I've talked to kind of look at me a little funny, but I argue a relatively uneventful quarter from a perspective of the market did very well, and we're going to dive into some of the data on that specifically, but more importantly, there was a lot of a little bit of craziness in the news cycle over the course of the quarter, and when we look at that versus market reactions, it was relatively, I generalize it, use the term boring, but that's essentially is what happened. And so, as many of you who have dialed into these presentations know, I always like to start things off with a lighter note. So this was a little bit of how we felt first quarter of the year, is waiting for the market to react to negative headlines, and it was like waiting for the next shoe to drop. Now, this data is based on Q1. I know for most of us that have paid attention to what's happened the last month, things have changed a little bit. But generally speaking, over the first quarter of the year, decent amount of pessimism, lots of headlines, not a lot of movement when we talk about the market um, in general. So, um, there are more things that are happening today where some of this data has changed and is outdated, but we'll address some of the macroeconomic conditions and kind of the look forward data conversation at the latter half of the presentation. So when we look at what happened over the first quarter of the year, and we look at major market indices, the U.S. market reflected on the top part of the screen, and we have the international markets there on the bottom part of the screen. And so these are reflected from January 1st to the end of March. As you could see, U.S. markets, every major index was up. We also saw growth in international markets. There are several international markets around the world that have seen um, significant growth. Japan, for example, is up to all-time highs, just as the S&P 500 is here domestically in the United States. And so we're seeing global growth. The one lag, if you wanted to call it that, would be emerging markets, um, growing at about 2.44% over the first quarter of the year. And so, generally speaking, we saw a decent amount of growth. As I said, like obviously, geopolitical conditions and some other things that have happened in the month of April have changed that landscape a little bit. But overall, given general pessimism, some news about stubborn inflation, the lack or perception of the lack of movement on interest rates in the near term, the market was still relatively resilient in the first quarter. And so if we look at the index performance a little bit closer, looking at the trailing 12 months, so basically the end of the first quarter of 24 back to the end of the first quarter of 23, what happened in several of the major indices. And then also on the right-hand side, we look at a measure of what percentage it is off of the all-time high. So you can see on the left-hand side a pretty decent amount of growth year over year, from the end of March 23 to the end of March 24, um, aligning pretty closely with what we saw on the previous chart as well. So a reemergence of tech and growth drove a lot of the performance in the Nasdaq, for example. Many of those stocks also exist in the S&P, are listed on the S&P 500. So a big driver of growth there, but also saw growth in the Dow Jones Industrial Averages. In terms of the trailing 12-month off of all-time highs, so when you're reading the chart on the right, really what we're seeing, those zeros reflected, are telling us that those major indexes are basically at this point at all-time highs. Um, the one exception to that is the emerging markets piece. That's emerging markets in general have taken a bit of a beating. specifically in how investors actually participate in emerging markets. Many funds over the past, 4 or 5 years have had exposure to countries like Russia, China, and a few others that have seen a pretty significant dip from an investment perspective, and valuation of their assets and just overall economic growth. So that one to be expected, but a lot of the other major indices, even in the international space, are right around or just at their all-time highs. So if we break it down sector by sector, we look at sector weighting or sector performance based on how investors actually participate in the market. So these are measures of the various sector ETFs that exist. As you can see, the Q1 return, energy, the highest performer, close second, communication services, industrials, and then technology. Rounding out the what we would refer to as our sensitive sectors. Um, the defensive sectors or defensive category, healthcare, consumer, utilities, all positive growth there. The one exception in any of the sectors that we watch and that we monitor was real estate. Um, One that's probably not particularly surprising to those of you that are listening in and to many of us with given the interest rate environment, giving there we'll talk a little bit about the housing market specifically, but when we look at the real estate industry in general and we think residential and commercial, um, there has been the higher interest rate environment has had an effect on growth in that space, specifically in the investment arena. So what you could see here is that most sectors are moving in a positive direction over the first quarter, some more than others. Although the Nasdaq as an index was the largest performer, we could see that technology by itself was not necessarily the biggest driver of performance from a sector perspective when we look at the market. Now, um, 10 of 11 S&P sectors posted positive returns. So we generally view that as a positive result when we talk about first quarter performance of the market as a whole. Breaking it down a little bit further, looking at asset class performance. So these are trailing periods. So we have a year to date, 1 month, 3 month, and so on. You could see the reemergence of U.S. growth. So the past couple of years, there's been a debate or a seesaw of growth versus value, and we've seen, you see here on the value, not far from the top here, the S&P 500 actually being a blend of both growth and value. Um, but what you'll see is that US domestic markets, and specifically in the large cap space, so larger companies, has been a big driver of growth generally from an asset class perspective, or a big the winner, so to speak, in these various trailing periods. We did see a reemergence of commodities, which basically over the long term, if you could see over the past 10 years, have been not super favorable. We did see a boost in commodities in recent years, and so an asset class that traditionally has been out of favor with investors has kind of reemerged as something that we're seeing more exposure in investment portfolios today. But the biggest takeaway from this is obviously we see a bit of a trend here, which there's been a ton of growth and a ton of upside in U.S. markets, particularly amongst larger companies, but also tremendous opportunities in diversification as well. And so when we talk about long-term investing, you could see that things that have performed better in the short term, some have kind of held their place, but there has been some bouncing back and forth between different asset classes over time. So let's talk about diversification. Something that you've probably heard us talk about or heard me talk about on previous webinars. We have a pretty big focus on diversification. Going back to the previous slide, as you could tell, like in recent history, US large cap has been a good place from a performance perspective to invest. But picking that one particular asset class or one particular fund lacks diversification. And when we talk about risk in investing, putting all your eggs in one basket obviously exposes an investor to more risk. And so when we take a deeper dive on, well, what's happened in these risk models or these sample portfolios. And so what we do with this, we take very basic risk models using Vanguard mutual funds, lower cost, not necessarily full disclosure, not an endorsement for all Vanguard funds, just a quick, easy, simple model that we can put together to kind of show what a risk-based model would have done as an investor can invest. And so we use the mutual fund models as well, because most investable assets in the United States today, a large chunk of them are in retirement plans, which typically use mutual fund investments. So when we look at the sample risk models, we have an aggressive, a balanced, and a conservative. And then we also have the S&P 500 just as kind of our barometer or measuring stick for an all equity type of portfolio. And so as you could see, as we ratchet down the risk, we do see that the rate of return comes down and everything has been relatively in line with its risk adjusted rate of return. There have been periods of time in recent history where we've seen this chart kind of be a little out of whack, so to speak, where we have a 50-50 portfolio outperforming an 80-20 or a 20-80 outperforming a 50-50. And so what we're seeing right now is uh, a trend of, I like to call it kind of reverting back to normal or revert. The technical term to that is like a mean reversion, which is there is a sense of normalcy, at least in this space when we talk about diversified portfolios and how they're performing against their counterparts in different risk allocations. The other thing that you can see from this is not only are the indices coming off of all-time highs, but these portfolios in particular with the funds that have been selected are also hovering around or right at their all-time highs as well. Again, data at the end of March, since this is a Q1 webinar, some of this has changed, no doubt, but generally speaking, the market and the market indices as well as many portfolios our model portfolios at this point are hovering around or close to historical highs from a performance perspective. So I want to switch gears really quick and talk a little bit about index concentration. So why is this important to investors, especially? Um, Index concentration has become a topic of conversation in recent years, primarily because you have these larger funds that provide diversification, provide broad exposure to a sector or an index in the market. So, for example, SPY is essentially an S&P 500 indexed ETF, um, which gives you broad exposure to that index. But when you take a look under the hood with some of these funds and these indices as a whole, what you can see is that there's relatively large concentrations within the top 10 holdings in each fund, uh, which also becomes a major driver of performance. And so when we did our kickoff for the year, we talked about a lot about what have been coined the Magnificent Seven, or the top seven stocks in the S&P 500 from market value, market capitalization value. So Apple, Amazon, Alphabet, Google, Meta, Microsoft, Nvidia, and Tesla. And so if you track those have been a huge driver of performance over the past calendar year when we look at, or trailing 12 months specifically, when we look at March of last year to March of this year. What you'll see is the S&P 500 as a whole, so we add everything else back into the pot, uh, that has been up about 27, almost 28% during that same time frame. So not quite half what those top seven stocks have been, but pretty close. And when you look at the rest of the S&P 500, so pulling out those seven, the total S&P 500 performance was around 28%. Without those seven companies, that performance goes to just shy of 20%. So what's the point here? I think there's been a shift. And when we talk about the idea of investment diversification, a lot of times, um, people will look at a fund like an index fund and say that is a properly diversified, like I get tons of exposure. The way the market has moved in recent years, even with that broad, relatively diversified list of companies, you do have some concentrated exposure to some of these. Now, couple that with an investment portfolio where you're using SPY and this is Invesco QQQ, which is basically a NASDAQ tracker. You combine those two together, you can see a lot of the names on this list are almost identical. So you're buying a pretty heavy concentration of those stocks. Now, over the past 12 months, that hasn't necessarily been, from a performance perspective, the worst thing in the world. But when you talk about a high level of concentration, especially in stocks that have appreciated at a very large rate like that, that also will increase your risk exposure along with that. So your exposure in an S&P 500 fund in terms of risk has changed, even though the fund itself and its objective hasn't changed. The risk of that fund has fundamentally changed over the past, 3, 4 plus years. And so it's something that I'll be honest, like a lot of investors don't really look at it in through this lens. They don't take these things into account. And we pay and have been paying much closer attention to these types of data points to ensure that we're getting the full picture of what's actually going on and taking a comprehensive look under the hood to make sure that that the risk exposure associated with a particular index or particular fund is still in line with an investor objectives. So when we look at winners and losers, so what's here's the silver lining in all that. Those 7 companies have been a huge driver of success in the S&P 500 index specifically. So when we look at winners and losers in 2024 so far, there's actually 2 charts here. So this chart on the left is the representation of all of them, but there was one crazy outlier here. A company called Super Microcomputer, which finished up 255% in the first quarter. So when I was running this chart data and pulling this from the system that we use for this, it zooms out quite a bit. So everything kind of looks clustered here in the middle. So the chart on the right is just removing that outlier and kind of zooming in to give you an idea of how many companies were considered winners or positive performers during the quarter versus those that weren't. And so for a long time, I should say for a long time, in recent years, there's been a heavy driver of the heaviest driver of positive performance in this index has been driven by the top quarter of companies. And there's been a lot less winners than losers, but the winners have been big winners. So when you look at the performance of the index, it's looked relatively positive. However, now what we're seeing is a shift where some companies that have underperformed or have not been positive gainers in that index are also following suit with some of those in air quotes magnificent 7 companies to help participate or help drive performance in the index as a whole. So as I mentioned, the best performer during Q1 in the S&P was Super Microcomputer or SMCI. What might be surprising, or maybe not, the worst performer was one of the Magnificent 7 constituents, which was Tesla, which lost, or the stock price was down 29.5% in Q1. So what that tells us is that there's a lot, and there's a lot of like conversation around these things, the Magnificent Seven, and should I be more concentrated in my approach because of performance? And the reality is that if you look at anything in a vacuum and you look at it year to year, month to month, quarters, you can break it down and frame things positively in any way. Ultimately, what you're going to see is when you're picking a fund like an index fund like this, the composition of that fund, like I said previously, is going to change constantly. And who's a winner, who's a loser, so to speak, based in the context of how we're framing it here, that will ultimately change. But the performance of the fund is really what reflects in your own personal investment performance and your investment gains. So diversification will matter. Not getting overly tied to like any one particular company or anything like that. Like, for example, Super Microcomputer, that's up 255% for the year. not mean that that's a attractive investment to now take a look at all of a sudden. So I just like to provide a little bit of perspective. These are all short-term metrics. Like this is by no means designed to give you a long-term perspective on how you should be repositioning money or trying to, bash index funds, for example. I think that they have their place, but understanding what's under the hood is just as important as understanding how markets are moving. So let's shift gears here. We talked a lot about equity investments. Let's shift gears to bonds and interest rates. And so this chart, quick summary of the yield curve summary, or quick summary of the yield curve, excuse me. So we break everything down by duration rate, and this is quarter over quarter changes. And so what was expected when the year started was um, possible cooling of inflation, the Federal Reserve changing their posture on long-term interest rates, possibly cutting rates several times. That hasn't come to fruition. And so what we've seen quarter over quarter is actually an increase in rates on a lot of these treasury securities. And so treasury rates have gone up. The biggest moves have been in some of the longer term, and I say longer term, but um, we still have a relatively what's referred to as an inverted yield curve, meaning that if I invest in a shorter term bond, that's actually paying me better interest than a longer term bond. The norm is the opposite, which is the longer the amount of time I'm lending my money to someone, government, corporation, whatever it may be, the higher the interest rate usually is. And so we've been in this environment of inverted yield curve, primarily driven by the fact that the Federal Reserve had increased and is maintaining a higher interest rate on the Fed funds rate, at least for the foreseeable future. A lot of that and their measuring stick for that, it has to do with inflation. We'll talk a little bit about that macroeconomic data here in a minute. But what the expectation was at the beginning of the year versus what we've seen has changed slightly, and I expect will continue to change every time Fed Chair Jerome Powell gets in front of a mic. People will be watching with great anticipation, hoping that something positive will happen on that front. But it does appear that they are going to be more conservative in their approach. So the expectation is that we'll see some of these treasury rates kind of hold steady for a bit, um, which will potentially not be positive for certain elements of the market. But when we look at it through an investment lens, you're going to get a much stronger rate of return and not have to lock your money up for a extended period of time. So that's the silver lining. More to come on that, and that will be I would venture to guess that we could have a completely different conversation when we do this webinar 3 months from now. But I think stay tuned for more on that. So let's talk a little bit about interest rates and spreads. I talked about the target federal funds rate. So right now we're at about 5.33 at the end of the quarter. Um, the target upper rate is 5.5. So that was expected to come down potentially. It has not to date. On the right hand side, we also see a measure that we look at, the 10-year Treasury yield spread. So what does that mean? It's a mouthful. It's effectively the difference between the 10-year and the 2-year. And so when we see what's referred to as an inverted yield curve, that's when we see that yellow line drop below that zero over here. And so inverted yield curves are usually an indication of a recessionary environment. That's been the conversation that's happened quite a bit over the past couple of years. Um, Sorry about that. I had an unexpected visitor. So with the 10-2 yield curve, um, that is a measure of a potential recessionary environment when we see that inverted yield curve. And so as a result, we've actually been in that environment for an extended period of time now, with really not a ton of movement when we talk about traditional definition of recession. The gray bars, by the way, on that right hand side of the chart are indications of a recessionary environment. So when we talk about the 10 to yield spread, we've been in this negative territory for quite a bit now. It's drawn attention of many analysts and economists, but nothing has come to fruition with that quite yet. We'll talk a little bit about macroeconomic conditions here in a minute and what's happening, why the economy has been resilient under these circumstances, and potentially what to expect and to look out for in the future. So we talked about treasury rates. Just to touch briefly on corporate bonds. I think this is particularly important, especially for investors. A lot of investors participate in ownership of corporate bonds. Um, Participate in ownership of corporate bonds and investment portfolios. And so the type here, these letter indications are a measure of credit worthiness. So AAA being the best, AA, single A, and then triple B. In our terms, in the investment professional terms, we talk about investment grade bond securities. And so what you'll see is that the interest rates and the yield rates on these have gone up quarter over quarter as well. So we're seeing a little bit, not so much in long term debt instruments, but we are starting to see a subtle increase in rates over the long term. And what you could see is like we've heard conversations recently, especially with mortgage rates and some of the other things. I think people really got used to this 2010 to 2020 environment in terms of what's a high interest rate. And so we've built a lot of assumptions, and what you could see is like many people came into the workforce. You have the millennial generation that kind of grew up financially in this space, and now we're seeing an increase in rates relative to history and to the lifetime of pretty much everyone on this call. Rates are kind of where they have historically been. And so why does that matter? Bonds specific, corporate bonds specifically, so just kind of tying this back to the investment conversation, they've kind of fallen out or had fallen out of favor in recent years when we're talking about investment portfolios, especially talking about generating retirement income. And now what we're seeing is that this asset class in particular has become a little bit more viable. There's actually an ability to earn a rate of return or earn enough interest to generate an income off of these types of securities, and we expect that will continue to be the case. And as the yield curve normalizes and we see the longer term yield curve increase, rates specifically increase, that will be something that I think will change in the framing of the conversation around investment portfolios, specifically with bonds and using those to generate retirement income. All right, shifting gears, economy. There's say relatively, I want to say a lot to go through, but I think some things that I want to spend a little bit of time on because I think they're important to understand and how they kind of affect the average everyday person. So when we talk about inflation and CPI here on the left, so core inflation for the United States, when you look at that here on the left-hand side and the consumer price index, what we can see is that we've come pretty far from our high of just over 9% when we talk about our measure of inflation, but we're still at about 3.5% and still far off of the long-term target by about another percent or so. There are questions if that long-term target will eventually change. Maybe that increases, but why this number is so important, that's effectively been the driver of the Federal Reserve determining how and when they're going to ease, specifically on cutting rates. So as that has remained steady, as you can see by this line here, in recent months, not much has changed on that front, and whether rates will actually change or there'll be any movement there. On the other side, we have to look at what's the rate of inflation been and what's the actual uh, growth rate of wages. So inflation is one thing, but being able to keep pace with inflation with the cost of living has been a particular challenge. Primarily because wages were relatively flat for a long period of time. We have seen some increase in year over year earnings in terms of wage increases, but when you look at average hourly earnings, you could see that's gone up. That's, just shy of $35 an hour. Um, real average, that's a measure of that, adjusted for inflation, over time. Oh, sorry. And then we have year over year gains and then the average hourly earning year over year. And so when you look at this, what does all this really mean? Just to kind of boil this down into a very concise point. Inflation has been relatively high recently. It still remains above what the Federal Reserve determines is a good long-term target. All the while, wages have increased, but essentially, workers are net even or behind in a lot of cases, depending on industry, in their ability to spend the same dollar the same way. And I think a lot of us probably feel that in different areas of our lives. I always kind of giggle when I see the rate of inflation because I think inflation rate to us, and I talk about this all the time, inflation rate to the individual is very different from household to household. If you're someone who commutes a long way, to get to work and you have to work in person these days, you probably have a much higher rate of inflation than others because the cost of gas, for example, per gallon has gone up. The cost of groceries. So if you have, like in my house, we have small children that eat fruit like it's going out of style. Fresh fruit is at the grocery store is no joke. So it's a situation where how you live your life and how you participate in the economy ultimately drives your own rate of inflation. And so when you use a measure like this and you look at wage growth and you say, well, inflation's been high, wage growth hasn't really kept up, and now the cost of the goods that I consume the most have actually increased at an even greater rate, that ultimately is going to cause a little bit of a cash flow crunch for many Americans. And so it's it hasn't, I think part of the pessimism when people look at the economy and outcomes is that they see the numbers on the news, but they don't feel them in their own bank accounts, in their own wallets. And I think that disconnect has also made it confusing too, from an investment perspective of like things don't feel that great for some of us. Some feel fine, some are a little concerned, or things aren't looking as positive, but the market still continues to charge forward on basically relatively positive and resilient economic data. So how do we digest that? And so I think that's something that many have focused on, and quite frankly, um, that's where I think a large disconnect is between the way we feel as consumers and what our consumer sentiment is, and ultimately what the market does from an institutional dollars perspective. So, taking another step forward and talking about employment, the U.S. unemployment rate has been pretty close to historical lows for a while now, post COVID. The job opening rate, the non-farm job openings, has come down pretty significantly. So we are seeing some cooling in some leading economic indicators as well, meaning that there have been tons of jobs open, not a lot of people to fill them. Labor force participation has been down. We're starting, I mean, it really hasn't gotten back to its pre-COVID levels, but we are starting to see jobs being filled. And so as a result of that, we have relatively low unemployment. Wage growth, like we just talked about, is moderate, I would say. It exists, but to what degree that it actually has an effect, um, is certainly up for discussion. When we look at um, U.S. quits, so non-farm, the quit rate, so basically the rate at which people are leaving their jobs, and then you're looking at layoffs. All of these numbers are well below highs, in some cases below their averages. And so employment data has been a big driver as well. You talk about inflation, talk about employment data, suggestive of a resilient economy. And so one other reason why the Federal Reserve has given pause on what they're deciding to do about interest rates to avoid basically getting back into this rapid increase in inflation and environment where we're right back to where we started before rising interest rates. Taking that another step further, when we look at GDP and public debt, so these are just measures. So just shy of $28 trillion of U.S. GDP, um, and you can see the quarter over quarter growth of GDP over time, and what the average is, and what's happened in recent history. I think more importantly, and what I would focus on, and why I included this chart was really more about this chart. So, one thing that's been fascinating to me throughout this process in the post-COVID world is that US consumer debt in particular has increased drastically. So we are in an era where for the first time ever, we have Americans have over $1 trillion of credit card debt in a fairly high interest rate environment when you look at variable APRs on credit card interest. Um, our US public debt as a whole is about 34 trillion, which is 121% of GDP. It's an interesting trend. This, I think, is one thing that gets lost in the shuffle. But when we talk about the Federal Reserve potentially keeping rates higher for longer, and as Americans continue to accumulate this debt, ultimately there will be some particular challenges with debt servicing in some of those um, some areas, and I suspect also will affect purchasing power in the economy when we talk about major purchases, but that use traditional debt for financing. Um, but this is something that you could see here, like post 2020, it's really taken off in a significant way, and it's GDP has also taken off at the same time, but it now officially exceeds our national GDP, and so um, basically, debt is a huge business in our country at this point. When we talk about relative numbers, and so again, I think the importance of this is really not so much to focus on economic growth is certainly important, but how we keep pace in other elements of our lives with that economic growth, and really, us as Americans from a financial planning perspective, making sure that we're taking stock of what we have going on and not overextending ourselves from a debt perspective. So for a long time, you could see the number was relatively low and at bay, and low interest rate environment also is a big driver of this. So there's a large portion of this that is, probably lower rate instruments. But you do see that there has been some sharp growth in this number in recent years. So um, not anything particular to note in terms of issues with that quite yet, but it was something that was a staggering statistic to me. So I figured it was, something that we could take a minute to talk about. Um, So let's talk a little bit about housing market data. This is one that I, particularly attached to just because um, I'm in the market looking for a new house. And so I'm an active participant, an active buyer out there in the marketplace. And these data points again are end of the quarter numbers. So the average 30-year rate was 6.79%. That's actually come up slightly during the month of April. Same for the 15-year, which is still um, above 6%. What we're seeing in terms of share of mortgages that are refinanced versus new purchase, that number, not surprisingly, has been down, primarily because of rising rates. A lot of people that are already in lower rate mortgages are obviously, unless they need to, going to refinance out of those to put themselves in a higher rate loan. Um, down here at the bottom, this indicator review. So this just looks at a bunch of different things, primarily how, things that are important to us or that I really kind of focus on: housing in terms of prices, housing starts, building permits, what kind of sales are happening. And so what you could see is that there's a little bit of a mix month to month. But compared to a year ago, with the exception of pending sales and housing starts, everything else year over year is up in these various categories. And so some not in a positive way. If you look at, 30-year mortgage rates, those are up. But we do see that building permits still slightly up. Um, we see that the price index is up pretty significantly, which is probably no surprise. It was no surprise to me as someone, again, who's currently shopping for a new house. So just continuing on there, I think this is something else that was interesting, and this has gone up and come down in recent months and over the course of the last year. But when we look at the median sales price for new houses sold right now, so new builds, the average price domestically is 400,000, just over 400,000. The average price for an existing home is 393,000. So those numbers, especially in the Mid Atlantic region, those don't seem like big numbers. But if you look nationally and you just look at the averages over time, if you just backtrack even to 2020, the amount of appreciation or increase in pricing in just that short period of time, heavily driven by low interest rate environment, highly competitive environment for purchasing, there's been a pretty big jump. And during 2022, also having a pretty big jump in interest rates we found ourselves in this little bit of a challenging environment for those that are trying to buy houses, especially for first time home buyers or even those that are families that are trying to move, like myself and my family, where the cost of purchasing this same home from 2020 to now has in many cases almost doubled. And so the same house, same mortgage has become increasingly more expensive. And so there's a lot of people that have differing opinions on what will happen with interest rates and what will happen with home values. But the general consensus is that values of homes are probably not going to go down in any significant way, regardless of the interest rate environment. And so on the flip side of that, there's anticipation that if rates start to come down, that prices will start to go up. Nonetheless, it is important to note that for those from a planning perspective, because we as financial planners like to kind of round this out and talk about it through that lens, um, your purchasing power in buying a home today versus what it was even 3 or 4 years ago has changed drastically. And I think it's very important to understand. Um, that will change over time. People buying houses today that are in a higher, 7+% rate mortgage may have an opportunity to refi into a better option in some time. When that time will be, nobody seems to know. That will be heavily driven by policy, specifically from the Federal Reserve. When we talk about existing home sales versus new family sales, we see that post COVID, there was a ton of building, a ton of new neighborhoods going up. That's since come down. Particularly challenging environment with rates and with builders, using financing to build communities. We did see a similar jump in existing homes as well, but that's actually fallen below um, that rate. So there's a lot of data on this screen. I think the biggest takeaway is that the landscape of buying a house has changed significantly, and I wouldn't expect that that will change much. I think this, to some degree, in this rate environment and pricing and how homes are being purchased has become a new normal, and I would expect that that would continue. Let's talk about consumers. How do we feel? The personal savings rate for consumers, again, no surprise, post 2020, lots of money pumped into the economy, increased pretty significantly. The average over time has been 8.62%. Now we're down to 4%. I don't find that particularly surprising either. given the environment, economic environment with just general cash flow. We talked about rate of inflation, increase in cost of goods. There also is just less money in the economy. There's more debt outstanding, consumer credit outstanding. Um, so consumer credit includes credit cards, other types of loans and lending. Um, but that 4% didn't surprise me when I saw it, primarily because I think that a lot of people are feeling the squeeze. There was a bunch of excess cash in the economy post stimulus. Um, and a lot of that has slowly started to trim away. We've seen deposit numbers at many banks go down. And so as a result of that, there's not as much saving going on because naturally there's more spending and there hasn't been proportional wage growth to help keep up with some of those increases in expenses. Um, this particularly will be challenging long term, obviously from a wealth accumulation perspective. The inability to save or to invest money over the long term um, will no doubt have a ripple effect on long term planning for a lot of the people that are not meeting that average or exceeding it. Again, we talked about credit and the kind of the rapid increase of that over the past 20 years or so. Um, Sales and consumer sentiment. Consumer sentiment has increased pretty significantly, probably much to the surprise of many economists, just because there's been an inverse relationship of late between market sentiment and consumer sentiment, which is typically unusual. Like there's not normally that level of disconnect between the two, but we have seen that the data has shown that in recent years that's been the case. Now, consumer sentiment was pretty low, 2022 with rapidly rising interest rates, a lot of doom and gloom. A lot of that has bounced back and moved closer to that average metric here on the screen. So what we're seeing, real estate, or I'm sorry, real retail sales year over year um, have hovered around 3.6, 3.5% roughly in terms of growth. So people are still spending money. People are still confident in economic conditions. And People are still proceeding with some pause and caution when we talk about markets. So we'll talk a little bit here in a second about investor perspectives and what you can do with all of this information. So last 2 points on economics, on the macro environment. So oil and gas prices. Um, right now, there's been some talks, and you may have heard on various news outlets that the amount of crude oil that we have in strategic reserves is below the historical average. As a result of that, the price per barrel of crude is elevated, which ultimately trickles down to gas prices. So we're seeing getting into a busy summer travel season, lack of reserves, and it's a supply and demand issue. It's expected that what the average is versus what we'll see at the pump over the summer will also increase. So when we talk about inflation metrics, in some cases that will be baked in, and um, that will certainly be a driver of overall inflation at a household level, but also at a national level. And lastly, we'll talk briefly about money supply. Um, so the M1 money supply, just to kind of define what do these things even mean. The M1 money supply is a measure of readily available liquid assets. So like think cash, um, things like money orders, like demand deposits, checkable, they call it checkable deposits. So essentially like money that you can get access to like immediately. It's there, it's usable. M2 money supply is a measure of money a supply that's M1 plus uh those that are held by households, individual households. So think like savings deposits, retail money market funds, things of that nature. So, in 2020, no surprise, we printed a bunch of money. And so M1 money supply quadrupled between March and September of 2020 and nearly quintupled at its peak in April of 2022. 20 trillion, over $20 trillion. And so it has contracted some. It's come down by about 2.7 trillion, or works out to be about 13% drawback since then. The M2 money supply um, is about $1 trillion, or roughly 4% below its all-time high of March 22. So tons of cash pumped into the economy. Now we're starting to see that some of that money supply is coming back down. Um, and so I talked a little bit earlier about people sitting on cash and having a bunch of readily accessible cash, some of that from stimulus, some of that from other things. Those numbers are starting to retreat a little bit. And so the long term optimism on the economy was that people weren't really spending as much, but they still had a bunch of readily accessible cash available. Now we're starting to see those numbers pull back a little bit. And so that will potentially change the outlook when we look at how to view the long term economic projections versus what we'll see in the short term. Short term, I don't believe that it's going to change a ton, but long term, if those numbers and that money supply number continues to come down, that will be an indication that deposits, readily accessible money, is starting to go away from household balance sheets, and therefore, as consumers, money we can't you can spend money you don't have in the form of credit, but there's a limit to that. So, um, something that is worth looking at and is particularly interesting in this case. So let's transition all of that. I'm almost done with the charts. I know I've charted you to death. Um, let's talk a little bit about just the investor pulse check. So we talked about the macro, we talked about performance, we talked about all of that. Investor sentiment, if you just like take away from the busyness on the screen here, investor sentiment is still relatively bullish. So the top chart is the VIX, which is a measure of it's a volatility index. It's currently below its 20-year average and near all-time lows, which is usually a suggestion of a positive investor sentiment. You could see that the VIX spikes in periods of recession or periods of uncertainty, and comes down in periods of where they're they're lacking volatility, or there's um, not as much worry out there in the market. When we look at the bottom chart, the investor sentiment piece, so you look at the average of 3.45%, you could see that that number is 27 and a half. So most investors surveyed feel like there's a case for being bullish when it comes to the market. Whether or not that will come to fruition, we could see that there's all kinds of instances where that's worked. That's been correct and not. You can see a lot of bouncing in this chart though, and I think that's a measure of kind of like our emotional uh, digestion of information and how things have gone, even in periods of sustained economic growth. You could see that everyone's always kind of waiting for the next shoe to drop, so to speak. And so, right now, investors are very positive. Um, I like to harness that positivity and use it for good. So, if we can keep that but also understand the data and not become overly optimistic, I think that's a perfect world to an analytic like me. I can't get away from this without talking about politics. It's an election year. So this is a question we get a ton, and this is probably one of my favorite charts. So Dimensional Fund Advisors, which is a mutual fund company, um, puts out a really good piece on this. And we did a presentation. We'll probably do another one this year, back in 2020, called Politics in Your Portfolio. Um, this is a measure of the S&P 500 index based on various presidential um, uh, presidents that were in office, at various points in time. So you could see there um, pictures at the bottom to represent each presidential administration, and it never fails. In an election year, we always hear, well, if this person gets elected, this is going to happen. If this person gets elected, this is going to happen. And so, um, political views aside and what preferences are, the data shows us that it's a very rare instance where during any presidential administration in history, there are some examples of that. You could see in Great Depression, 1929, and then George Bush in 2001 to 2009 with the tech bubble, 9/11 on the front end of the decade, and then the back end of the decade, we had the housing crisis. Other than that, in most cases, most presidential administrations have experienced positive market growth when we talk about US domestic markets. So I don't have any other insight than that on this at this juncture, but I'll say that um, regardless of political affiliations or beliefs on how this will affect the market, it's no doubt that certain political environments do have an effect on the market. For example, you have a dominant party all the way through government, or you have a split party. Historically, ironically enough, the market actually tends to perform better in a split government. I don't know if that's our way of saying we like when you guys can don't really have the ability to do anything, but that's just how it's played out historically when we look at the data. So we'll do a deeper dive on this and really talk through the data and the metrics of it and look at political cycles. But we're coming up on one in November. No doubt there will be some volatility in the market. There'll be some different opinions and there'll be different outcomes. But the one thing that this chart always tells me, and the one thing I like to emphasize, is that the number one factor in performance during a presidential cycle is our own investor behavior. I'll leave it at that. So let's talk about what to watch. Important things, potentially stubborn inflation. Talked about that and how that will affect interest rate policy. Changes in leading economic indicators. So I talked a little bit about the jobs market, employment, some cooling in some areas there. Focusing on corporate earnings. So are companies still making money? Are they going to meet expectations that have been set by them from analysts and from Wall Street? And how will that affect share prices and movement of the market? Bigger focus on international economic growth. I think since COVID, international markets have kind of got kicked to the side. You know, the US has been relatively resilient, but we're starting to see a pretty big bounce back in other parts of the world and one that can't be ignored from an investor perspective. Again, focusing on interest rates and paying attention to what's happening there, and seeing how that will ultimately affect our bottom lines as investors and as US consumers. Um, and then expectations. While good news can affect the markets, it's important to understand that when that good news is priced in. So, put another way, if there's an anticipation that something is happening, typically because the market is a leading vehicle, it's trying to predict the future. The stock market is designed to what will happen in the future. You'll hear people use terms like it's baked in. And what does that mean? Really, what that means is the market has already anticipated that something is going to happen and it's positioned itself so that there's been growth in the areas that will benefit from that. And so, if you're behind the curve on that, you effectively and you wait for the news or that thing to come to fruition. In a lot of cases, that may already be priced in, and you might not see as significant of a move as you were expecting. So, um, emphasis on the importance of discipline, getting in the market, staying in the market, and all of those investor perspectives that we kind of really drill down on every time we do these seminars. But more importantly, just setting your expectations that some things that you think are going to happen in the future might have already been taken into consideration when we look at the market as a whole. So, concluding thoughts. Near-term outlook for the economy and markets is constructive. So, there's been strong economic momentum. There's robust corporate earnings. There is some improving conditions in and international economies, excuse me, and there is a decelerating inflation trend. It hasn't decelerated enough for the Federal Reserve to make any movements on interest rates, but it is coming down. Natural question. So, all right, great. What could go wrong? Well, if the job market starts to cool, that could be a potential problem economically and also just what happens in the markets. If inflation begins to re-accelerate for some reason, that could be particularly challenging. That could lead to an additional interest rate hike instead of a cut. So a more hawkish Federal Reserve position. Um, And, a lot of good news appears to be priced into the financial markets at this point. So it's a question of how much additional good news will actually drive additional growth. Probably the most important piece of this entire presentation, promoting discipline. There was a lot that people were worried about going into 2024. Geopolitical environment, a lot is still going on. I know that the month of April has been relatively volatile as a result of some of that, but the economy has continued to grow and the stock market indices have achieved all-time highs in the first quarter of the year. So despite all those negative headlines, despite some of the things that have happened, the market has not given us a reason to be overly pessimistic or as pessimistic as we maybe started the year, and that's reflective in performance. So that doesn't mean that that will continue throughout the year, but I think that it's understanding what's going on and what truly has an effect on the market and what doesn't, and to what degree. Um, and so we talk a lot about this, and I think human behavior is a big driver of investment performance. So the idea behind a lot of these. So I do see one in here. Sorry, I missed that at the top of our call. Talking about market dip with issues in Iran and Israel. Was it about war possibility? Is it about the war possibility or a time for a market adjustment? Um, I don't particularly believe that that is an indication of a timing of a market adjustment per se. There is not a anything indicating specifically from an economic perspective. So when we look at the market and predicting the future, if you want to say that, because that's really what's happening. The market is effectively a crystal ball vehicle. And so when we look at what's to come, I think a lot of that pullback is an indication of fears around geopolitical issues, um, and not so much about economic conditions. And so those things tend to be, I'm not saying that this is definitely the case in this scenario, but those things tend to be, um, not to overgeneralize it, but they can be a flash in the pan, so to speak, where it's a short term pullback, doesn't affect long term outcomes, um, and markets have an opportunity to potentially bounce back after that. Um, Sorry, I think my internet went out, so I'm not sure how much of that you caught or what we covered here. But just to reiterate, the answer to the question that was asked, I think the pullback in April to some degree is heavily driven by geopolitical concerns. Economically speaking, there's no like a clear indication that people are predicting poor economic conditions in the near term, at least. So near term, I think U.S. economy and the outlook is relatively, as I mentioned in the presentation, relatively constructive. Long term is a different story, and a lot of it will be contingent on how certain things play out this year, um, in a lot of different arenas. And so, I have full expectation that there will be some volatility in the latter part of the year, primarily like depending on what happens with interest rates. You also have a political cycle happening. There's a lot that will be up for discussion at that point. But as of today, we don't see anything. We see everything relative through a relative lens of status quo, basically. And so, as a result of that, we still think that the investment philosophy and strategy that's been put forth to date, is still gives us a clear path for long term success.
Ryan, another question just came in saying, It looks like the growth sector has outperformed over the last few years. What are your thoughts on value dividend paying stocks?
It depends on your investment perspective. And I know we're over time here, so please feel free if you guys have questions, if anyone needs to go, you're welcome to, and you can feel free to ask us any questions offline. Back to that question, it's a great question. I think it's about your perspective and kind of where you are in your life from a planning perspective. So, like, for example, if you're in retirement, value, no pun intended, may not provide a lot of value and appreciation of the value of the stock, for example, that you own, but it does provide value through dividend payments and potential for income. And so it understanding not just the asset class and how it's performing, but understanding the use of it is a whole different conversation. I think the conversation that gets lost too frequently, where everyone tries to look at the percentages, and we may even be guilty of it to some degree because we're putting the percentages on the screen here, but um, the percentages and the growth of the growth versus value fund or individual stock is always going to be important and relative to the investor that owns it. So we believe that there's still a case to own some growth and value. Growth has no doubt outperformed value. And a big driver of that has been technology, innovation, changes, companies like Nvidia and others in the microchip space. That has been a huge driver of growth for those types of companies. And we're seeing it in a lot of different ways. I mean, the largest performer over the quarter was another technology company. So that's been a big part of it. I do think that there's still a place for value, though. Those companies that you can kind of hang your hat on, that are going to pay a dividend, that are going to have good cash, and good balance sheets, and are going to be around. I think that's the other thing too, is that when you look at performance over the long term in the life of a company, um, growth stocks sometimes transition themselves into value, and other times they fizzle out and go away. And I think that gets lost a lot of times. Now, there are certain examples of that where they have a tremendous amount of staying power, but I I'm in the camp of I think that both have a place. If you pay close attention and you get attached to the individual asset class performance, you will be disappointed from time to time. But the old saying of if you properly diversify a portfolio, and this is from our perspective, I tell clients this all the time. If we practice proper diversification with your investments, we're always going to have to apologize for something. But that's how it works. That's how it's supposed to work. You're not going to have big winners in every single category. If you do, that means when the market goes the opposite direction, you're going to have big losers, and they're all going to move in the same direction. And so that's really where planning focus comes in. And that it's kind of separating two conversations. There's the investing, what's the best for my rate of return, and then what's the best for me accomplishing the goals that I've set out for myself, using these investments as a funding vehicle to accomplish those goals.
Thanks everyone for your time today. I know we're a little bit over, but we'll stick around for another minute or two if any more questions come in. But we'll set a follow up with recordings to everyone who attended today, and we really appreciate the time and hope you got a lot out of it. Thank you.
Awesome. Thanks, everyone.